Hello learners, welcome back to a Foundation Principles and Practice of Accounting Marathon Revision. You might have already seen part 1 previously. Part 1 or lecture 1 comprised of chapter 1 and chapter 2. Chapter 2 all the units except for the last unit, that is rectification of errors. So in this part 2 video we'll be starting with rectification of errors, go on to do BRS and valuation of inventories. We're going to do all the concepts without solving any problems on the same. You would have to do the problems on your own, especially because in this marathon revision I'm trying to cover all the concepts theoretically, conceptually, so that you will be knowledgeable enough to solve all in the span of about 5 to 6 hours. So doing problems also within 5 to 6 hours will become very much challenging. Yeah, done. So before I get started with part 2, I have a small announcement to you, all of you people. This regarding the free mega test revision conducted by Unacademy. 30 minutes, 20 MCQs will be conducted on the paper of accounts on June 15. June 18th will be law, June 21st will be mathematics, and June 23rd will be economics, mathematics and economics. So, what are you waiting for? Download an Academy application today, enroll yourself for this mega revision free test series, and then take up the test of 30 minutes for 20 MCQs. And CA Intermediate Mega Combat is also coming up on June 12th, which you can enroll for. The advantage of enrolling for this Mega Combat and then giving it is you would get huge discounts on CA Intermediate subscription, which is the need of the hour right after you finish your CA Foundation examinations. And you see the discounts that is given right off here as to how much of discount that you get for CA Intermediate subscription. And you know the iconic subscription, which is the flagship model of Unacademy. You can take up CA iconic subscription and then avail the benefits of one-to-one personal coaching, one-to-one doubt solving, evaluated test series, hard copy of the material arriving at your doorstep, sessions from industrial experts, and also you get to be not part of not discussion channel for all your doubts. And the usual plus benefits though are always there, like live classes, recorded classes, backup is available, one subscription giving you access to all the educators notes. So this benefits will continue to be there. To take up subscription of CA Foundation Iconic on Unacademy, all you'd have to pay is 41,000 for 24 months, 28,600 for 12 months, and 20,500 for 6 months. And if you use the code YESHAS Live, which is YESHASLIVE, you avail 10% off on the prices that you just see on the screen now. So what are you waiting for? Download Unacademy application today. Follow me, CA Rajavardhan on Unacademy for all the updates on my classes on Unacademy, and see you in the regular classes which will take up for CA Foundation, Intermediate, and beyond. Now let's get started with our topic of rectification of errors. So errors is something that's inevitable, which is very human in nature, which will happen in the course of accounting. And when these errors do happen, how do we rectify this or how do we correct these errors is what we are going to learn in this chapter. So rectification of errors, chapter 2, part 8, unit 8. When we start discussing, we need to first analyze the errors into several types before we go ahead and then rectify them, because the type of the error will decide how the rectification has to be done. So we can majorly classify the errors into two categories. One is non-clerical error, other one is the clerical error. Non-clerical is the error which clerk doesn't do, and the clerical is the error which only clerk can do. It is not automated or it doesn't happen with regard to computer. Non-clerical errors are principal errors. When we say principal errors, is it PRINCIPAL or PRINCIPLE? Is not principal, it is principal. So non-clerical errors are principal errors. That is when you treat a capital item as revenue, or you treat a revenue item as capital, meaning you purchase an asset and by mistake write it in the purchase book. That is a principal error. Or you purchase goods, you instead debit it to the asset account, meaning you maybe incurred some small repair expenditure on the furniture. You would have to write repair account debit to cash. Instead of writing repair to cash, you wrote furniture account debit to cash, meaning repair to furniture is wrongly recorded as if there is purchase of furniture. That, my friends, is principal error. A transaction recorded in contravention of accounting principle. That is capital and revenue principle. You remember capital and revenue that we discussed in the previous session? We discussed when to capitalize item, when to revenue, treat an item as revenue. If that is wrongly applied and you treat capital item as revenue or vice versa, that becomes principal error. So example, like I mentioned, asset purchase wrongly recording purchase book, or repair expense debited to asset. Then we have clerical errors which the clerk will do in the process. These can be classified into three classifications. First one is error of omission. Error of omission can be further classified into two categories. One is error of complete omission and then error of partial omission. What is error of complete omission? There is a transaction which is completely omitted, which is not at all recorded. That is error of complete omission. You purchased goods but didn't record the same. You sold goods but didn't record the same. That, my friends, oh, this is omission. What is it? Error of omission. A transaction is completely omitted to be recorded in books of accounts. Example, asset purchase not recorded, repair expense not recorded is complete omission. Similarly, we'll have another error of omission only called as error of partial omission, meaning a transaction is omitted partly, means it's recorded partly as well. So a transaction has two aspects, debit and credit. You record the debit aspect, don't record the credit aspect, or you record the credit aspect, don't record the debit aspect. Such an error will become error of partial omission. So error of partial omission is not recording a part of a transaction. Example, asset purchased not recorded in asset account but recorded in cash account. Or this example is not completely correct. It's little error. I'll correct it later. So it is like asset purchase. It is debited in the asset account but not recorded in the cash account credit. Or goods purchased. It is recorded in the purchase account but forgotten to be recorded in the creditor account. Such a transaction will become error of partial omission. And then we have error of commission. What is error of commission? Here it is not omitted, it is recorded but recorded wrongly. How is it recorded wrongly? Either it is recorded at the wrong amount or it is recording the wrong account. You purchased goods. Instead of writing purchase account debit, you wrote sales return account debit. Possible. Or you purchased goods from Ramesh. You're supposed to credit Ramesh account. Instead of writing credit Ramesh, you wrote credit Suresh. Very much possible. Or you purchased goods for 10,000. Instead of writing 10,000 rupees debit, you wrote 1,000 rupees debit. So all of this will become error of commission. So error of commission is a transaction entered at wrong amount or recorded in wrong account. Example is goods purchased from Ramesh wrongly credited to Suresh, or purchase of 4,500 recorded as 5,400. All of this will become error of commission. Then we have the next error coming up. It is called as compensating error. Here, one error will compensate to another error to make it look like there is no error. But frankly speaking, there are two errors. There are two errors. Do you get this? So one error has compensated to another to make it look like there is no errors. But frankly speaking, there are two errors. That is compensating error. What is compensating error? It is one error which is compensated by another error to make it look as if there is no error. That, my friends, is compensating error, and this is introduction to types of errors that we have. Next, let's go ahead and then see what is the impact of these errors on trial balance. Now, what is the impact of errors on trial balance? Some of the errors will result in mismatch of trial balance, meaning trial balance will not tally because of this error. But that's not going to happen with regard to all of the errors. Only some errors will do this. Whereas certain errors, no, though those errors are there, still the trial balance will tally. So depending on the impact on the trial balance, we will classify the errors into two categories. Number one-sided error. Number two-sided error. If it is a one-sided error, the error will affect only one side. Either it will affect the debit side or it will affect the credit side. That's it. Two-sided error means it will affect the debit side as well as the credit side. If the error is one-sided error, it will affect debit or credit, only one side. The trial balance will not tally. Trial balance will not tally. However, if it is a two-sided error, meaning if it will affect both debit and credit, then trial balance will pakka tally. In spite of the error, trial balance will still tally. So trial balance is not the conclusive evidence of correctness of accounts. Though the trial balance tallies, there can still be some errors. What are those errors? Two-sided errors. Now let's see. What errors are one-sided errors which will lead to disagreement or because of which trial balance doesn't tally? Yeah, and what are the errors which are two-sided errors because of which trial balance will, in spite of which trial balance will tally? This principal errors, are they one-sided or are they two-sided? These are usually two-sided errors. The transaction is recorded correctly, but only the capital item is treated as revenue or vice versa. So error is only in treatment of capital and revenue, but it will not lead to disagreement of trial balance. So in spite of this error, trial balance will still That is principal error. So principal error is a two-sided error. Next we have with us error of complete omission. Error of complete omission again is a two-sided error, meaning debit is also not recorded, credit is also not recorded. So in spite of a error of complete omission, trial balance will still tally. However, not the same in the case of error of partial omission. Whenever there is error of partial omission, trial balance will not tally. Why? Debit is recorded or credit is not recorded, or credit is recorded and debit is not recorded. When one of them is recorded and the other is not recorded, trial balance will not tally. And with regard to commission error can be one-sided or can be two-sided. Depends. Whenever you treat wrong account or wrong amount, that wrong amount can be both sides. Wrong account can be both sides. So it can be one-sided, it can be two-sided. And compensating error will usually be two-sided error. It's the same entry written wrongly. You get what I'm trying to tell? That is the classification. And whenever there is an error, we need to rectify. If it is one-sided error, trial balance will not tally. There will be suspense account and rectification will be through suspense account. If it is a two-sided error, it will not affect trial balance. Trial balance will tally. There will be no suspense account. So we need not write the rectification entry through suspense account. That's the learning here. And will the suspense account come in the rectification entry? This depends upon the type of the error. Yeah, in order to rectify the errors, we must identify the errors and we must identify the stage at which the error is it also depends upon stage at which the error is identified. If the error is identified before we do trial balance, then there is no concept of suspense coming in. Why? Suspense account is opened only on trial balance, not tally. So though it is one-sided error, if it is identified before trial balance, there will be no suspense account in the rectification entry. So that is something that we need to remember. So rectification happens depending upon the stage at which the error is identified. Now let us see stages of identifying the error. If the error is identified at stage 0, that is instantly, you made the error now and right now you understood that there is an error. Will you do some accounting? You don't have to do accounting. You will scratch it and then rewrite it. You will scratch that error and then rewrite it. Or when you're doing the entry, you will do backspace, and then rewrite the entry. So you don't have to do any rectification to be learned in accounting, not rectification. It's like layman basic thing that we do. You get this? This is not part of our syllabus either. Then we'll go to stage 1. It is identified before trial balance. Meaning you did some error. That error was identified before you go ahead to prepare trial balance. So trial balance didn't reveal this error. Before preparing trial balance only you understood. In such a case, trial balance is not prepared. So one-sided error may trial balance not telling and suspense and all won't come. So even if it is one-sided error, we will not be adjusting through suspense. What will we do? We'll do mere adjustment. That ledger may some amount is missing. You would make some entry in that ledger exclusively and then close this. You can't pass journal entry. Why? Error is only in one side. In order to pass journal entry, you need two sides. You can't do journal entry with one side. So you do one-sided error ke liye adjustment only. However, if it is a two-sided error, there are two sides where there is wrong. Then you can pass journal entry. You have two sides, no? You can pass journal entry. This is stage 1. One-sided error adjustment, two-sided error journal entry. So how do we get to know in the exam that it is one-sided or two-sided? It will be usually given to you in the question. They will tell following errors were identified before preparation of trial balance. Following errors were identified after preparation of trial balance. They will tell that. However, whether it is one-sided or two-sided will not be given in the question. That has to be learnt by you over a period of time by practice. You have to do a lot of problem practice to understand and get into that groove wherein you can easily make out whether it is one-sided error or two-sided error. Got it? Then stage 2 is after preparation of trial balance. Now trial balance was made, then you understood, Asha, there is an error. Then if it is one-sided error, what you do is you don't do adjustment anymore. Why? The moment you prepare trial balance, that trial balance didn't tally, you put it to suspense account. Now that suspense has to be closed by rectifying the error. So you would pass the journal entry with suspense account whenever one-sided errors are identified after trial balance. However, if it is a two-sided error, you pass simple journal entry without any suspense, like we did in the previous case. And in certain scenarios, trial balance is done. You opened suspense account. You still didn't identify the error. You prepared final accounts. Final accounts are also shown. Next year, may you identified that there is an error. Then what do we do? Stage 3 after final accounts. Whenever the error is identified after final accounts, then the rectification will be like this. If it is a one-sided error, we do journal entry with suspense account. If it is a two-sided error, we do journal entry without suspense. You would say then, sir, stage 2 and stage 3 look very similar. You don't find any difference between stage 2 and stage 3, isn't it? They look very similar. Sir, what is the difference? There is difference. There is difference. Whenever rectification is done at stage 2, whenever rectification is done at stage 2, then you can use any ledger account to rectify them. However, whenever the rectification is done at stage 3, we need to remember that all the ledger accounts relating to expense and income are closed in the previous year. All the expense accounts and income accounts of the previous year are closed in the previous year. We can't use them for rectification in the current year. We discussed this in the ledger, no? When you are closing ledger accounts, real and personal accounts are balanced by carried forward to subsequent year. Nominal accounts are closed by transfer to trading entity. If there is an error in purchase account, sales account, any expense or income account in the previous year, and you identify this year that there is an error in the previous year's purchase or sale or expense or income, we can't rectify it in the current year by debiting, crediting expense, income, sales, purchase. Reason being, in the current year, if you debit purchase, credit purchase, or debit or credit sale, income, or expense, it will not rectify your previous year expense or income. In fact, it will make the current year expense income also go wrong. It will make the current year net profit wrong. So what do? Whenever we do rectification at stage 3, whenever we do rectification at stage 3, that is after final accounts, we replace items affecting profit or loss with P and L adjustment account. Replace items affecting profit or loss with P and L adjustment account. If in case our rectification entry is purchase account debit to creditor account, that is a rectification entry that we need to do. It is that entry will be passed in stage 1, stage 2. In stage 3, instead of writing purchase account debit to creditor, we will write P and L adjustment account debit to creditor's account. I hope you got this. That's an important point that you need to know. You need to do a little bit of problem practice after this. I have done last 2 mock test papers detailed discussion in the Unacademy special class platform. My profiles link is available in the description. You can get in there or you can get in touch with me on Telegram. I'll share the link with you. We've done question on rectification of errors and we've done question on all the topics that way. So last 2 mock papers will give you a lot of confidence for the examination. Yeah, done. Then steps to pass the rectification entry. How do we pass the rectification entry? In order to rectify, the first thing that you need to do is you need to identify what is wrong. Step 1 is identifying the wrong entry. Step 2 is reversing the wrong entry. Step 3 is passing the correct entry. These 3 are working notes only. The rectification entry is step 2 plus step 3. So the reversal of the wrong entry plus the correct entry, if you do, you will arrive at the rectification entry. Let me repeat. The reversal of the wrong entry plus the right entry will lead you to the rectification entry. Now I'll quickly tell you a couple of important points that you need to remember with regard to rectification chapter. You need not write this step 1, step 2, step 3 in the exam. All you have to do is straight away write the rectification entry. However, for any adjustment, if you so find difficult, you can write these 3. You will not get marks for writing this, nor will you lose marks for writing this, but you can opt to write. This is one thing. Second thing is solve few problems with full attention to identify and understand when is it one-sided, when is it two-sided. Done. But remember that they will always mention in the question whether it is after trial balance, before trial balance, or after final accounts. That will be given in the question. The last important point is if it is after final accounts, remember to replace all the items affecting profit or loss with P&L adjustment account in the rectification entry. Done. So then what's left after this is only problem practice, which I've done in a very good extent in our fast track revision first batch, fast track revision second batch. We've done all the RTP, MTP mock test paper questions in that. I hope if you have access to, you can watch that and then understand that. Because this is a marathon revision, I will not be able to solve problems. I'm only covering the concepts in the syllabus in detail. Done. So this is, guys, with regard to our chapter of rectification of errors. We'll now start with the topic of bank reconciliation statement. So let's start with the topic of bank reconciliation statement. chapter 3 of your CA Foundation Principles and Practice of Accounting. To start with, the question number one that all of us have is, what exactly is bank reconciliation? Answer to which is, it is a statement. See, do you see that black color statement word going to green? That is the answer to the red color question. What is BRS? What is BRS? It is a statement. Then the next thing that we need to note is, then why do we prepare it? If it is a statement, not an account, then the question is, why is BRS prepared in such case? If it is a statement and if it is not an account, then BRS is prepared to ensure that we reconcile the difference between the balance as per passbook. What do you mean by reconcile? Identifying the reason for difference. Whenever there are two people fighting, you'll identify, what is the reason they are fighting. That identification of the reasons is nothing but reconciliation. Here, the bank balance is different as per cash book and different as per passbook. Now, when there is difference, it is because might be because of some error or might not be also. But there is a possibility that there is an error. We need to identify the reasons so that we can check if any of the reason is an error. If there is an error among those reasons, we need to rectify. If not, no, we'll leave it like that. So to check if there is any error, we will do this entire reconciliation. Yeah. So to reconcile, that is to know the reason for difference. Why do we want to know the reason for difference? Because one of the reasons for difference can be an error. Done. So what are the reasons for difference? We're talking about balance as per cash book and balance as per passbook. What is cash book and passbook? I have kept my money with the bank. When I keep my money with the bank, in my book I'll write how much money do I have with the bank. That book where I have kept the record of what's with the bank is cash book. And banker has kept a record of how much money I have received in his way. A copy of it is made available to me. That copy, which is prepared from the banker's perspective, is what we call as passbook. Got it? So basically we'll find the differences between the balance as per passbook and cash book. So what is cash book? Record kept by me. It refers to the bank column of cash book. What is passbook? It is the account kept by the banker. Copy of the transactions as it appears in banker's book. Now come on, let's identify the differences between. What can be the reasons for differences between this? The reason for difference can be, I have issued a check which is not deposited into the bank, or I have issued a check which is deposited into the bank but not clear. What is this? I have given a check to somebody. Whenever I give the check to someone, I'll write the entry, that person's name, debtor account debit to, what is it, creditor account debit to cash, or creditor account debit to bank. I wrote that. The moment I made that entry, my bank balance reduced. However, my creditor has not deposited the check with the bank yet, or my creditor has deposited the check but the check is not yet clear. Because of this, what can happen is, I issued the check, I made the entry, this is my cash book, this is my passbook. C for cash book, P for passbook. I've made the entry in my cash book balance has dropped. Whereas the entry is not made in my passbook and my passbook balance is not dropped. This is a valid reason. This is a valid reason for difference. Cash book decreased, passbook is not. Can you see the P? No. In order to see the P, either you would have to see up or P down. See up in the sense add in the cash book or decrease in the passbook. Depends upon the scenario as to what do you have in your country. If you're starting with the balance as per cash book, you need to add checks issued but not deposited to arrive at passbook balance. Or if you're making changes in the passbook, you would decrease or you would deduct the passbook balance to see the P, meaning to arrive at the cash book balance. As and when I'll discuss the adjustment, I'll tell you how to treat it in the BRS preparation, so that you will get a quick revision of the addition and subtraction also. I don't believe in giving you the format of what items to be added or what items to be removed. I hope this helps. Done. Then the second reason for difference. Similar to the fact that you have sold goods, you have purchased goods from someone to whom you have issued a check, you might have sold goods to someone who has given the check to you. So whenever the checks have been received and deposited but not clear, or checks have been received but not deposited, that can also become a reason for difference. Meaning, you have received the check from your debtor, for which you write the journal entry, bank account debit to debtor's account. Tuck, 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 tuck. When you do this, your balance as per cash book increases because you made the entry. You have not deposited those checks with the banker, or you deposited them but they have not yet cleared. Because of this, your passbook balance will not increase. The balance as per cash book has increased, but the balance as per passbook has not increased. There is a difference. Do you agree with me? So in order to decrease this difference, what should we do? If you are starting with balance as per passbook, you need to add to the passbook balance to arrive at the common balance. Or if you're making changes in the cash book, you need to decrease. In our tone, can you see the P? No. In order to see the P, either you'd have to P up or you'd have to C down. That is the logic that we use to adjust this adjustment. So in the cash book, this will be deducted, or in the passbook, this will be added to arrive at the other balance. Got it? Then let's go to the third reason for difference. Third reason for difference is I'm a busy man. I've been selling goods, purchasing goods, doing business quite often. I can't wait to collect every check. I can't wait to issue. So what my customer has done, he didn't want to bother me. So he straight away goes to the bank and deposits the check on my behalf with the bank. My customer goes to the bank and directly deposits the check on my behalf with the bank. This is direct deposit by customer into bank. Whenever my customer directly deposits the check with the banker, my balance as per passbook would increase because banker will increase my passbook balance. But I don't even know that my customer has deposited. I won't write entry in my cash book. So my cash book balance is not increased. Let me repeat. My customer has directly deposited the check with the banker, because of which my balance as per passbook has increased. I have not made any entry in my cash book. My balance as per cash book is not increased. So passbook balance has increased, cash book balance has not. Can you see the P? No. Is there a difference? Yes. How do we reconcile this difference? In order to reconcile this difference, if you are starting with passbook balance, if passbook balance is away, we will reduce it, we will P down. If what we have in our control and what we know is cash book balance, from cash book balance if we start, we will add to arrive at passbook balance. This is adjustment number 3, and I hope all of you understood. Then let's go to the fourth one. So we have issued checks against the purchasers. We have received checks against our sales. Some customers have directly deposited money into our bank account. Why? Because now I've grown. Now I've become busy. Similarly, what I do in this case is whatever the payments that I need to make, like electricity payments, water charges, internet expenses, or rent expenses, all of this, I won't do them manually. I will automate them. I will go to the bank and then give them standing instructions to make the payments on my behalf. And banker will make payments on my behalf on standing instructions. So whenever banker makes payments on the standing instructions given by me to the banker will reduce my passbook balance. But I am not even aware of the exact amount because I have given the instruction to pay, not told him how much. Whatever is the bill, you pay that. So my cash book balance entry is not made. So cash book balance is not reduced. Can you see the P? No. Is cash book passbook balance matching? No. So what do we do in this case? In this case, we need to reconcile. If we're starting with cash book balance, we need to C down or reduce the cash book balance. Making changes in passbook, we need to P up or add to the passbook balance. That's how we reconcile payments made by the banker on standing instructions, which will be recorded in passbook and not in cash. Next thing, like I've asked the banker to make payments on my behalf, I will ask the banker to collect receipts on my behalf also. I'll say whatever dividend that I'll get on the shares, you collect it. And to that guy, you know that you see there, I've paid him money, he'll give interest, you collect it. I'll tell to the banker. I'll tell my banker, okay, banker, do you see that blue shirt guy? From that blue shirt guy, collect 10,000 every month. Why? He should give me interest. I can do that. I can give standing instructions to banker to collect money also on my behalf by way of dividend, by way of interest, and all these things. And banker will collect. And whenever banker collects these receipts on my behalf, or I might have sent bills for collection also to my banker. Whenever banker collects all of these, he will increase my passbook balance. But I have not made entry in my cash book. My balance as per passbook has gone up, but not my balance as per cash. Why? Entry is not made. Is there a difference? Yes. Should we reconcile? Absolutely yes. How do we reconcile? Making changes in passbook, we need to reduce it. If we're making changes in cash book, we need to increase it. This is how we rectify the or reconcile the changes. Do you get this? So receipts collected by banker on standing instructions will be rectified by either decreasing the passbook balance or increasing the cash book balance, as the case may be. Let's go to the sixth one. The sixth one is, why does the banker give all these services of collecting money on my behalf, paying money on my behalf, clearing checks? For all of these services, no, banker will charge me some money. Banker will charge me some money, and that money is what we call as bank charges. And this bank charges, whatever the banker charges, would have recorded in passbook only. So banker has recorded in my passbook for all the bank charges, because of which my balance as per passbook has decreased. Banker has recorded his charges, because of which my passbook has reduced, but my cash book balance has not. Can you see the P? No. In order to see the P, either we'd have to increase our passbook balance or we would have to decrease our cash book balance. So what do we do? If we're making changes in cash book, we'll C down or reduce our cash book. Making changes in passbook, we'll P up or add back to our passbook balance to arrive at the other balance. And that's how we adjust bank charges recorded in passbook. And the next one is, when we keep money with the banker, it is responsibility of the banker to keep us interested. Why? He's charging us charges, so I might move on to another bank. No, correct, isn't it? How does the bank ensure that we stay interested in them? Banker ensures that we are interested in the bank by giving us interest at regular intervals for the money that we keep with the bank. And whenever banker gives the interest, he doesn't come to me, knock the door, knock knock, tell one knock knock joke, give the interest, thank you, what is it, congratulations, you earned interest. Banker doesn't do that. Banker just deposits the interest in the bank account like that. Whenever the banker does that, balance as per passbook will increase with no change in balance as per cash. Because we are not aware, we didn't write them. If we have not entered the bank interest in the cash book, but bank interest is recorded in the passbook, that will become a reason for difference, which needs reconciliation. If we are starting with balances per cash book, we need to C up or add. If we are starting with balances per passbook, we need to P down or deduct to adjust bank interest credited in passbook only. Next, friends, let's go to the eighth one, which is errors in cash book. Whenever there is errors in the cash book, like what to say, bank receipt, or what to say, check received of 1,000 wrongly recorded as cash receipt, or check received of 1,000, it's been wrongly recorded as cash received. You get this? Or check received of 4,500 wrongly written as 5,400. These sort of errors can happen. An entry recorded at wrong amount, or entry omitted to be recorded, cash receipt wrongly recorded as bank receipt, or bank receipt wrongly recorded as cash receipt. All of these can happen, because of which there can be difference. And this has to be seen at the merit of the adjustment. Yeah, it is not always add or not always less. If it is, for example, see, cash received of 1,000, wrongly you wrote it in the bank column. What will happen? Because of this, cash book would increase, passbook would not have increased. Starting with cash book, you need to deduct. If you're starting with passbook, you need to add. However, alternate scenario, there is a bank receipt of 1,000, there is a check received of 1,000 which is deposited uncleared, but by mistake in the cash book you wrote it in the cash column. Now what will happen because of this? Passbook has increased because it is correctly bank receipt, but entry is wrong in the cash book, not recorded. So what do? In the cash book we add, or in the passbook we deduct, either of the cases. Understood? So this has to be seen at the merit of the adjustment. And next one is, we do errors, banker also does errors. Errors can be there in the passbook also. If there are errors in passbook, again that needs to be adjusted. You will just see it at the merit of the adjustments and then decide what is to be done to rectify. This, my friends, is the differences because of which we do rectification. Sorry, reconciliation. Then what or when is BRS prepared? BRS is prepared. The frequency of BRS depends upon the scale of operations. It is at the management's discretion. You can prepare BRS annually. You can prepare BRS quarterly, monthly, weekly, or even daily basis. However, management discretion paid they can decide, but mandatorily BRS has to be prepared before preparation of balance sheet, because we need to check whether the balance as per cash book is correct or not. So management can decide to do, how often to do, but before preparation of final accounts though mandatory. See, when is BRS prepared? It is prepared at regular intervals at management discretion, but must prepare as on the balance sheet date to understand whether the balance in the balance sheet is correct or not. I hope you all understood. Then the next question is, which balance is to be shown in balance sheet? Should we show the balance as per cash book, or should we show the balance as per passbook? Frankly speaking, the answer is neither. It is not balance as per cash book or balance as per, because there will be differences between them. No, we'll check the differences between them, identify if there are any errors in that differences. If there is any errors, we'll rectify those errors. So after rectifying those errors, what we arrive at, no, that balance is called as amended cash book balance or adjusted cash book balance. Such adjusted cash book balance will go to balance sheet. Remember this. So what do? We do identify differences between cash book and passbook, and we see to it that are there any errors in those differences. If there are any errors in those differences, we will rectify those errors, then identify the adjusted or amended cash book balance. Such adjusted cash book or amended cash book balance will get posted to that's it. So what goes into balance sheet is balance as per amended cash book. How do we find balance as per amended cash book? We start with balance as per cash book. To this we do plus or minus non-timing differences, meaning differences which are not arising because of time. That's how we arrive at balance as per amended cash. Now we'll ask me a question, sir. What is this non-timing difference? Non-timing differences is errors in cash flow, because timing differences means this is a difference only and it has arisen because of time. Over a period of time it will get rectified. Over a period of time it will get, you just give some time and that will get rectified. Whereas non-timing differences means this will not be cured by time. These are errors, these are not timing difference. Now how do we classify this? I'll help you understand. This is difference between passbook and cash book arising for a reason other than time. These are genuine errors. These are genuine errors. Now let's see. We discuss those errors. No, checks issued but not deposited, or checks issued deposited but not clear. Check has been issued. You have given the check to someone. They have not deposited, or they have deposited but not got clear. Give another week's time or 2 3 days time, that check will get cleared and the balances per cash book and passbook will match. So you don't have to do anything to make that cash book and passbook match. You don't have to sit and chant Gayatri Mantra 10 times for the check to get cleared. No, check will get cleared. It's a matter of time. Maybe it is second Saturday followed by a Sunday and then Monday is some festival. Tuesday it will get cleared. You don't have to do anything. It will get cleared automatically. And check not getting cleared is not because of your error. So it is a timing difference. Green flag is timing, red flag is not timing. Then checks deposited, checks received and deposited, or received but not deposited, not clear. So over a period of time, it will get cleared. No. So you don't have to do anything. So this is again a timing difference. We'll go to the third one, direct deposit by customer. Our customer has directly deposited the money with the banker. If we don't make the entry in our books for such deposit, there will be always difference between cash book and passbook. If we record that direct deposit by customer in our cash book, then cash book passbook will immediately match. So this third error is there, no, direct deposit by customer into bank. This is not because of time. This is sheerly because of your error of omission. This is your error of omission. So this, my friends, is a non-timing difference. Then the next one, what we have, payments made by banker recorded in passbook, not recorded in cash book. This is not because of time. This is non-timing error. We have failed to record. It's an error of omission. If you record it in the cash book, passbook will match. If you don't record in the cash book, even after 10 years, the difference will still be there. So this is a non-timing difference. Then same is the case with regard to receipts collected by banker on standing instructions. Receipts have been collected, banker has recorded in passbook. If you don't record in cash book, the error will be there forever. It is an error. It is not a timing difference. It will not be cured by time. You have to make the entry. So this item requires adjustment. This is a non-timing difference. Then lastly, what do we? Then we have few more. No, sixth one is bank charges. Record in passbook only. It is recorded in passbook. It is not recorded in cash book. It has to be recorded in cash book. If you don't record in cash book, it is not timing difference. It's an error of omission, my friends. So this is again a non-timing difference. Same is there with regard to interest recorded or interest created in passbook only. And if there is errors in cash book, the name itself says errors. However, if the error is in passbook, we can't go make the adjustment for this. I can't go to the bank and then say, can I make double entry in your accounting package? They will slap me on the cheek and then say, get out. If the error is there in the banker's book, banker will make the entry. I can't make the entry. Max to max, what I can do is I can write a letter to the bank manager and then request, sir, there is an error in your error in the passbook that you have done. Please correct the same. We will write it only if there is wrong debit. None of us will do it if there is wrong credit. I know. Recently it did happen, no? In the case of HDFC Bank, 1,500 crores of money was wrongly credited to customers. Yeah, I am not the lucky one. I didn't get any money that way. Yeah, if there is error in passbook, banker has to correct it, not us. All we can do is write a letter. Writing a letter is not a transaction. So this is a timing difference. So direct deposit by customer, bank charges not recorded, bank interest not recorded, direct payments made by bank, receipts directly collected by bank, errors in cash. All these are adjusting errors or non-timing differences requiring adjustment in adjusted cash. Checks deposited but not cleared, checks what to say, checks deposited but not cleared, checks received but not cleared, and errors in passbook. These are timing differences. You don't have to do rectification for this. You can only reconcile them. This will remain in PRS. You get this? This, my friends, is which items are to be adjusted. Now that we need to, what we need to remember is which items will go to amended cash book, which items will go to BRS. Let's quickly revise. Items which are non-timing in nature, non-timing differences will go to amended cash book. You will prepare amended or adjusted cash book. Such amended or adjusted cash book's balance will be starting point in BRS after amended cash book. There we write all the timing differences to find the balance as per past. Couple of important points that you need to note. Point number one, sir, when should we prepare amended cash book? Usually, they will always mention in the question. You prepare amended cash book only when they mention in the question. In the question, they'll say prepare amended cash book and BRS after amended cash book. They will say that. Only in such case we need to prepare. If they don't tell that, if they say just prepare BRS, we'll just prepare BRS. However, it had so happened in one of the attempt that question paper told prepare BRS, and in the answer paper there was amended cash book and BRS after amended cash book. So students were like, sir, will we lose marks? No. When the papers were corrected, evaluators gave marks to the students who prepared only BRS also, which majority of the students did. So I say will still give marks if you prepare only BRS, if the question doesn't ask you to prepare amended cash. However, it was clearly mentioned there saying that amended cash book is given for clear understanding only. So amended cash book has to be prepared only when it is asked in the question. If not, there is no requirement to prepare. Remember that. And the next thing is, whenever you need to do amended cash book, it has to start with balance as per cash book only. You cannot start with balance as per passbook to do amended cash book question. First, you prepare cash book, balance brought down, all the rectification of errors, basically what you learnt in previous chapter, arrive at the amended cash book balance. Starting with amended cash book balance, you will prepare BRS to arrive at passbook balance. If it is not a question on amended cash book, there can be questions wherein you start with passbook balance, end with cash book. But if you do ACB, amended cash book or adjusted cash book, it has to be started with cash book only. Got it? Last point with regard to overdraft. I see a lot of students getting confused with regard to overdraft. They change the entire scene. I tell you, don't change the entire scene. If it is overdraft balance, you don't have to say all the less items will become plus items, all the plus items will become less items. They'll do full confusion, full natak. Don't do so much of drama. Simple. If the opening balance is negative, it is overdraft. Just keep that balance negative. That's it. If they say balance as per cash book is overdraft of 10,000, all the add items, less items, let it be usual. When you write balance as per cash book, write the 10,000 as minus. Over. Because overdraft means minus. And end answer, if you get passbook balance also minus, right? Balance as per passbook minus 12,000. Let that be. Don't write overdraft balance is minus 12. Always keep the numbers negative, words positive. That is happy math. If you keep the words negative, then English will complicate your mathematics. Let's not do that. You got it? So if it is overdraft question, don't try to get too much tense and don't try to revoke or what to say reverse lot of things. Write that overdraft balance as minus. That's it. And rest of the problem you do it the same way. You'll get the correct answer, and you will also save a lot of time, and your brain will also stay cool in the exam. So this, my friends, is the discussion with regard to bank reconciliation statement. Now, as we're done with chapter 3, now we'll move on to chapter 4. Let us now get started with chapter 4, that is valuation of inventories. So one of the tricky chapters you can see of your syllabus, and fundamentally conceptually very important chapter that you have to do before you go into final accounts. and lot of relevance or lot of reference to consignment and goods sent on or goods sent or return or approval will come in this chapter. So let's get started with chapter 4 of your syllabus, the last chapter in this video, valuation of inventory. So what exactly do we mean by the word valuation in here? So valuation means now after you write your answers also they'll be evaluated, meaning the answers that you write, which is qualitative in nature, will be represented in terms of numbers, which is quantitative. 4 marks for this, 18 marks for this, 16 marks for this, totally 95 marks. Successfully you cleared your CA foundation. Congratulations, welcome to CA intermediate. So you measure it in terms of numbers, that is valuation. Similarly, inventory also will be valued not by way of marks but in terms of numbers or money. So valuation of inventory, what we do is we quantify the inventory in terms of money. So representation in terms of money. What do we represent in terms of money? Inventory. Inventory can be classified into three major classifications. It will include finished goods, work in progress, and raw material. You guys get this? I hope it's all fine and then going in sync and then getting recorded fantastically. All good. Now, finished goods. What do we mean by finished goods? Finished goods is an item which is kept ready for sale, which can be sold like this. For example, a t-shirt in our case. Not like a black t-shirt that I'm wearing right now, maybe something more that you can relate to. Yeah, the touristy traveler t-shirt, which has a very, very, very renowned traveler on it. Dora, Dora Akka, Dora the Explorer. Yeah, this t-shirt is what I'm selling, which is pink in color, which is kept in the sale for ordinary course. This is the finished goods. But if I have to make this shirt, I need to buy the cotton, convert that cotton to thread, then to cloth, then cut it, stitch it to make the t-shirt. So in the mid stage, wherein it is cloth stage or it is in the thread stage, that's what we call as work in progress. Meaning this is half converted to finished goods but not fully done. In the process of getting converted into finished goods. So in the process of production for such sale, like thread, that's what we call wool or thread. I'm like not a vegan completely, but I'm against being animals grown for the sake of wool. So I'm saying it cotton. Yeah, cotton. It's cotton. So plants is okay. You say you won't harm plants, then you can't survive. So in the process of making up the shirt, you use the cotton. That cotton is nothing but work in progress, and that cotton comes from the plant, no? So that plant may, whenever it is there, it is for consumption of production of goods and services. When you buy, that's left with you, that's what we call as raw material. So in my go down, if I have some cotton left, that's what we call as raw material. In my go down, if I have some what to say, thread or cloth, that's what we call as work in progress. And the fully finished shirt which is there ready for sale, that's what we call as finished goods. And it will also include the supplies and consumables. If I use some buttons on the shirt, or if I use some pattern ink on the shirt, or all of those things, dyes, all of those things are also considered as raw material. So in my balance sheet, I need to record this raw material, work in progress, and finished goods. How do I record it? Because these inventory items, I have no place in books of accounts, because closing stock is not a transaction, it's an event. There will be no have you ever seen opening stock account debit, closing stock account debit, credit, vice accounts? No, right? But still, closing stock should come in my final account. It should come in my trading account. Only then my GP will be right. Only if my GP is right, my net profit will be right. Only if my net profit is right, my capital will be right. And if in case I don't write this inventory, my balance sheet will also show wrong figure. Financial position also will go wrong, isn't it? So I need to value this inventory at a very important as a very important item, so that my financial statement show the correct value. So in this chapter we're going to run around and understand how to value the inventory. Yeah, so valuation of inventory, the significant importance of valuation of inventory is determination of income. With wrong inventory we'll arrive at wrong value. So how does it impact our income? That's what we're going to learn now. So inventory is vital in computation of income. We know that gross profit is computed as selling price minus COGS, and COGS is computed as opening stock plus purchases plus direct expense minus closing stock. So there we have closing stock. If closing stock is wrong, COGS is wrong. If COGS is wrong, GP is wrong. That's the reason I'm trying to tell you that it is important in computation of income. Or if you go for trading account approach, again there we'll write opening stock on the debit, followed by purchases, correct? Less returns, then we'll write direct expenses, then we'll write sales, then we'll write closing stock and find the total on the credit, then post it to the debit, and then find GP as balancing. If in case our GP changes, or if in case our closing stock changes, GP will change. So closing stock is a vital important item in computation of GP. It will have an impact on income. So this has to be computed correctly. What is the impact that the closing stock can have on the gross? Opening stock is 10, purchases is 40, direct expense is 5. If I assume my sales as 1 lakh, these all assumed figures. So, and assume our closing stock to be 25. Then our total on the credit side will become 1 lakh 25. Same will get posted to the debit side 1 lakh 25. And GP, which is found as balancing figure, will be 125 minus 55. That's about 70,000. If in case now I'll just change this closing stock from 25 to 30. My closing stock increases by 5. My total on the credit side increases by 5, bringing up to 1 lakh 30. And the total on the debit side will become 1 lakh 30, leading to change in my balance in figure, moving it from 70 to 75. So with increase in my closing stock, there is increase in my profit. I hope you all understood. Yeah. If in case I decrease my closing stock from 25 to 20, then my total will not be 1 lakh 30 or 1 lakh 25. It will become 1 lakh 20. And the total on the debit side will become 1 lakh 20. The total on the debit becomes 1 lakh 20. Then you know that my GP will become 65,000, which is the conclusion is simple, guys. If the closing stock increases, profit increases. The closing stock decreases, profit decreases. And closing stock has an impact on income. You got it? Going a little further, if I tell you that this morning the breakfast that I had is chana, or what you call as lemon rice, lime rice, lemon rice, chitrana. We had chitrana. Now, if you had chitrana for morning, what does it mean? It means that last night somebody didn't have dinner and ordered pizza, because of which rice was remaining. So previous night the rice, if it's remaining, they do chitrana the next morning. That is a usual household trend here in South India, or at least at our house. You get this? So the leftover rice of previous night's dinner will become this morning's breakfast. Previous night's dinner is this morning's breakfast, meaning closing stock of previous year will become opening stock of this year. Closing stock of current year will become opening stock of next year. Sir, why are you telling all this? I told you some time ago about the closing stock of previous year being more, being less. This closing stock of previous year being more or less will impact our current year opening stock. You guys get this? So let's now see the impact on the opening stock. Assume opening stock is 10, purchases 40, direct expense 5, sales 1 lakh, closing stock 25. Same figures that we had previously. Total on the credit side will become 1 lakh 25. Same will get posted to debit side. And then we have 10,000, 40,000, 5,000. 55,000 if we deduct from 1 lakh 25, we'll get 70,000 as our closing as our gross profit. Now if I play with my opening stock, change my opening stock from 10,000 to 15,000, then to say the totals will remain the same. Now my GP will decrease from 70 to 65. Why? The total 1 lakh 25 is same, no? If opening stock increase, GP has to decrease because they're in the same house. In the other logic, if I decrease my opening stock from 10 to 5,000, then totals are same. My GP will not be 70 anymore. It will not be 65. So it will become 75. So what is the logic? If the opening stock increases, GP decreases. If the opening stock decreases, then the GP increases. Got it, my friends? So this is the logic. And you need to remember this for the exam, because the question can come. What is the impact of stock on the profit? This was there in the second mock test paper, the question that they had given. A beautiful question which didn't just ask you to reconcile the closing stock value, but also asked you to recompute the profit pay impact is arising because of the change in the stock. So very beautiful question. If you have not solved, please go and solve mock test paper mein valuation of inventory ka question. One of the beautiful question. In our ICM material also similar question is there. Hanuman question, similar one. I've done it, and my mock test paper revision what I've done is on the free class platform. All of you can easily access it free of cost, and all the solutions with detailed explanation to each ad item. See, when it comes to valuation of inventory chapter, I understand that all of you find it difficult to identify which item is to be added, which item is to be deducted, why to add and why to deduct. I've not just added or deducted the items, I've given reason why it is added and what should you think before you add or deduct. when cost price, when selling price, detailed explanation I've given it. And please do ping me and then ask me on Telegram. I share the link to the Excel sheet which has detailed explanation to all the adjustments in mock test papers. And I have similar solution data free to watch for all the past exams, RTPs and MTPs also. You can ping me. I can share the Excel sheet with you, which has all the links to all the classes that I've taken previously on an academy, a free live class platform, as well as on YouTube channel. Fantastic. So let's go ahead and then see this. How do you remember what is to be added and what is to be deducted? The logic goes back to the movie of, you know, this topic is difficult, but same thing. Om Shanti Om movie. I'm not referring to this song of Om Shanti Om, but I'm referring to the other song of Om Shanti. If you remember this song, wherein initially it's only Shah Rukh Khan in the song, little later Sanjay Dutt comes, Salman Khan comes in, Saif Ali Khan comes in, Arbaz Khan comes in, Kareena Kapoor, Karishma Kapoor, Rani Mukherjee, Preeti Zinta, Juhi Chawla, Kajol. Everyone keeps coming into the songs. No? So a lot of people come into the songs. So do you really think it happens free of cost to just make a call and then people come? No. Just imagine the producer's mindset. When more people come into this song, you need to pay money to more people. When you pay more money to people, your profits will reduce. Do you get this? So Om Shanti Om mein what happened is Sanjay Dutt plus Saif Ali Khan plus Salman Khan plus Shahrukh Khan. Because of this, what happened? You made higher payment to actors, which resulted in lesser profit. Correct? Huh? Same is the logic for OSO. Om Shanti Om. Opening stock overvalued. OSO. Profits decrease. What is OSO? Opening stock overvalued. Now let's do the opposite. OSU. Opening stock undervalued. So it will be ulta. Profits will increase. And now we'll see closing stock overvalued. One opposite. Instead of opening, we're taking C. Opening ke jagah pe closing. Closing stock overvalued. So this will be ulta. Again, we'll do profits increase. However, when you do closing stock undervalued, CSU, two opposites, minus minus will become plus. So here we'll do profits will be decreased. So this logic was taught to me way back in my tax classes by Vijayaraja sir. I still remember, grateful to him, all the credit to him for teaching subject with Bollywood and making it something which you can never ever forget. It's been a decade since I've learned it from him, but it's something that cannot go out of the mind. So maybe it can run for few decades, and I'm going to take this concept with me to the grave. And all thanks to you, sir, for making subject so easy and making subject so memorable for us. And I hope you guys will also remember it for times to come. And then remember what sort of an impact will stock have on profit. Sir didn't teach us foundation accounts, but sir used to teach us taxation at CA inter level. So in PGBP, when you're trying to compute the profit to be taxed, net profit as per P&L, say net profit taxable income when you're computing, if the profit is overvalued, undervalued, what sort of an impact is it going to have on the profit? You need to rectify the profit and then take it into your tax computation, isn't it? That's where the concept had come. I hope you guys understood this part. So you need to do a lot of problems on this and then understand this. Questions do come and do solve that MTP to me, whatever question is there. Next thing, the significance impact is to determine the value of the inventory, which because it will impact the valuation of your income. Next thing is it will also impact your financial position. How? The correct value of the what to say inventory will be recorded in balance sheet. The value of the inventory is wrong, balance sheet my value will be wrong, and your financial position will also be stated wrongly. So this is regulated by accounting standard 2 issued by ICAI, Institute of Chartered Accountants of India. In the previous video, part 1 or lecture 1, when we discussed accounting standards, towards the end I told you AS2 will discuss it in chapter 4, that is next video. So herein we are doing. And in the next video, part 3 or lecture 3 on CA Foundation Marathon Revision, we'll be touching that AS10 part, which is relation to our depreciation and property, plant and equipment, fixed asset part. Yeah. So chalo, let's get going. Let's see what according to accounting standard 2 should we do in this topic. Yeah, it is an accounting policy. So and accounting standard 2 is mandatory. It's statutory compliance, which is also a significant part of inventory valuation. Let us now understand as to what does AS2 say. We need to be paying key focus and attention on paragraph 5, para 5 of AS2, which says that accounting. Oh, this I should have asked you as a question. It's okay, I can still ask you. Come on, boys and girls, answer this question for me. What is valuation of inventory? Is it an accounting policy or an accounting estimate? Drop in the comment section as to what is your answer is. I'll be very eager to see all those comments in the comment section and then see if you have got it right or not. Yeah. So it is accounting policy and not accounting estimate. If you remember previously when I discussed in the part 1, lecture 1, I had told you very clearly in the example section. It is accounting policy. It is part of accounting policy. Depreciation is not an accounting policy, it is accounting estimate. However, valuation of inventory is accounting policy. Got it, guys? Huh. So para 5 of AS2 basically tells us how to value the inventory. Para 5 says that inventory should be valued at cost or net realizable value, whichever is less. Cost or net realizable value, whichever is less. This is by way of prudent estimate or conservative approach, you can say. Conventions may be discussed, do you remember? Now the question is about what is cost. Let us now focus on the word cost and then understand what is cost. Now cost will include three items. One, cost of purchase. Two, cost of conversion. Number three, all other costs incurred to bring the item or the inventory to its present location and condition. So cost includes three items: cost of purchase, cost of conversion, and all other costs incurred to bring the item to present location and condition. What do you mean by cost of purchase? Cost of purchase includes the money that we pay to the seller when we basically got the product, or the amount that we need to pay to the seller. However, in this computation, we should still include the taxes if if such taxes are non-refundable. Meaning, we need to think from GST perspective. If input tax credit is available on these goods and we can take that money back from the government, then such input tax credit or such GST should not be included in the cost of the asset or cost of the goods. If input tax credit is not available, then you need to include such duties and taxes. Yeah, if you still have the doubt, the point is whenever you pay tax on the product that you buy, you can adjust it against the tax that you collect when you sell. Only the net differential amount is paid to the government. If this kind of input tax credit facility is available to you, then you cannot include such tax as part of the cost. Why? It is not part of the cost. It is reimbursable. However, if input tax credit is not available on such goods, then the entire amount of tax or duty will be included in the cost of the goods. And the next thing is freight inwards, meaning any expense incurred for movement of goods into the organization, freight inwards, that will be included. Yeah, it might be paid by you directly, or sometimes the seller will give this service to you and you would have to pay him separately. Such amount is also included in the cost of money. Next, trade discount. If he gives any discount, that trade discount should be deducted. After that only we compute the amount that we need to pay to the seller, isn't it? So the amount that we consider as cost of purchase is net of trade discount, and that's how we arrive at cost of purchase. The moment we buy these goods, we convert them to finished goods, no? So that cost of conversion is also part of the goods, cost of the goods. So cost of conversion is the expense incurred to convert our cotton to thread and thread to shirt, thread to cloth and cloth to shirt. Then the expenses incurred in converting raw material or work in progress to finished. Now example, it can be direct labor, the stitching cost, or variable overhead like depreciation on the machinery, or lighting, heating, ink cost, dye cost, button cost. All of this will be cost of conversion. Done. Then the next thing is other cost. Any other cost that is incurred in the process of bringing that finished goods to the location where it is, or the condition what it is. Yeah. For example, if there is items, I'll tell you the item and I'll tell you whether it is included or not included. Yeah. First item, administrative overhead. It will be included if it is in nature of bringing the goods to present location and condition. If it is post production administration, if it is administration after the goods are manufactured, then that is not included. Or if such administration is at a different level and it is not factory level administration, then again it's not included. And losses, if the loss of cotton, loss of thread, loss of cloth, it is normal in nature, then it is included as a part of the cost. If it is not, then it is not included. It will become abnormal loss and it is not included in the normal cost. Then storage cost. Storage cost incurred till the time the goods are ready to be sold is included, or if it is part of the normal production process, that this kind of expenses is incurred, and without this kind of expense, production is incomplete. For example, if it is wine production or rice production and everything, you will take substantial period of time now to complete the production. Then it will be included. If not, it is excluded. And interest and borrowing costs, usually it is excluded. Usually it is excluded. In a very rare scenario, it can be included. That is given in A16. But right now you can say that is if the item takes substantial period of time to be set up, then what is that substantial period? Definition comes to 12 months. All that is there. Then you can ignore. You can say only if the production is really long, it is included. Otherwise, it is excluded. Example is wine, rice, timber. It's not tinder, it is timber. Timber. Yeah, certain things need to be stored for a really long time. Only then they become a ready-made product to be sold. In such case, we'll include that interest and borrowing cost for such period of storage. If not, that's the cost bifurcation and then understanding. So this is how we arrive at out what item to be, what is to be included, what is not to be included, and what forms part of the cost and what doesn't form part of the cost. As now we've understood how to arrive and how to compute the cost. Let's now understand how to compute net realizable value. I hope it's all smiles with regard to cost. See, smiling, no, you know how the cost is computed. Let's now go to net realizable value. Net realizable value computation differs for each of the items. It is different for different items. It is different for cost of the goods. Okay, I missed out on that. That presentation is still in making. Let's go down and then write it in the PDF. Yeah, net realizable value is computed differently for different items. For raw material, the computation is different. For work in progress, the computation is different. And for the finished goods, the computation is quite different. For computation is basically done like this. You can remember it this way. It is computed like this. We'll take the sale price minus selling expenses. Expenses incurred to sell. When we do that is when we arrive at the net realizable value. For a finished goods, selling price is readily available. We'll take the sale price. Selling expenses can be commission, can be brokerage. If we deduct that, we'll arrive at net realizable. For work in progress, it cannot be sold in the semi-finished state. They will say a certain price provided it is finished. That selling price of the finished goods will write here, and selling price will be conversion cost. Cost that needs to be incurred to convert the work in progress to finished goods and then fetch this selling price. Yeah? However, with regard to raw material, there will be no net realizable value, replacement price. The value at which that raw material can be replaced will be considered as net realizable value. Got it? So with regard to finished goods, we take selling price minus selling expense. With regard to work in progress, we'll take selling price if the product is finished less conversion cost of that raw material of that work in progress to finished goods. Difference between those two will become our net realizable value. For a raw material, best estimate available is always the replacement. Got it? So that's how we arrive at net realizable value. Once we arrive at net realizable value, we need to identify the item which is less among work in progress, whichever is less of cost and NRV. Whenever you do whichever is less, we need to do it item wise and not in total. This is what usually we do in the regular class. Lot of items के लिए cost and NRV is given. So we don't take the total sentencing. We need to see item wise. See, for this Zen car, cost is 2 lakh, market price is 2 lakh 10. So we take 2 lakh 10. Similarly, here 3 lakh 15, 3 lakh 70. We need to take item wise. Item wise. For each inventory item separately we need to do, and we should not do it in total. This is what accounting standard 2 says. I hope you understood this part. Then we'll move on to the next part. Inventory valuation techniques. How to value the inventory depends upon the type of the inventory. Item can be usually ordinarily interchangeable, meaning one item can be replaced with another very easily, or it is not ordinarily interchangeable. It's a unique product, maybe like a designer wear or a custom made one. These days you see, that pant project may pant is custom made for every customer, or designer jewelry or designer kurta or something, yeah, which you get designed from a fashion designer. Such items is not ordinarily interchangeable. If the items are not ordinarily interchangeable, we go by specific identification method. Specifically, we identify the value of that item. If it is ordinarily interchangeable, Considering historical cost, we can do first in first out method. That is FIFO, LIFO, last in first out, SAM, simple average method or weighted average method. Or without considering historical cost, you can do adjusted selling price method or standard cost. Standard cost method you don't have in foundation, you can ignore. But you will do quite questions on adjusted selling price method, FIFO, LIFO, SAM. There was one instance where they had asked LIFO in the one of the November 19 examination, if I'm not wrong. And usually the questions come on stock reconciliation only from this. But nowadays they've started asking questions on this also. Got it? And maintaining of records, there can be two systems. One is perpetual inventory system, other one is periodic inventory system. Perpetual inventory system is records are kept. What is there? Records are kept. And here records are not kept. Yeah, the accountant is sleeping. So what he does is he uses COGS formula to arrive at the inventory. COGS is opening stock plus purchase minus close minus what is say cost of goods sold. Like COGS is opening stock plus purchase plus expense minus closing stock. What it does is he will put the CS this side and COGS this side. He'll do opening stock plus purchase plus direct expense minus COGS to arrive at the closing stock value. How do we do this? Opening stock of this year is closing stock of last year. That's available. Purchases we'll understand by understanding the total payments made, and COGS is basically found as total sales made minus our total profit margin, percentage margin. Once we eliminate that, we get COGS, and using that you find closing stock as balance. This is not scientifically correct method, but it is followed when the records are not maintained properly. And this proper records are maintained is on any given day, if you ask how much is the closing stock, they'll be able to tell. Why? For every receipt, for every issue, it will be recorded. Done. I hope you are familiar with those questions on how to compute FIFO, LIFO inventory. So we need to practice that. All I would want to tell you is I want to quickly revise as to how do you prepare FIFO, LIFO, SAM and WAME answers. In first out method, what we do is out of the first purchase, you issue the goods. Whatever was purchased first will be issued. Whatever was purchased later will be issued later. So what comes first will go out first. You get this? So you maintain multiple variable items in the balance column. You maintain them separately and then you write it. Under LIFO, what is the latest stock will be issued first. If you have two variants of stock and you need to issue inventory, you will issue from the most recent stock, not from the old stock. That is LIFO. And under LIFO also separation is maintained as to when did you receive. However, when you come to simple average method, no separation will be maintained. You will mix all the inventories and then write them together. You add up the old quantity with the new quantity and then write. Rate will be found as average. Old rate is 10, new rate is 11. You do 10 plus 11 divided by 10.5. You give no importance to the quantity of units. You take the simple average of the rate and then record the inventory. However, under weighted average, you don't do that. Under weighted average, you do old quantity into old rate plus new quantity into new rate whole divided by the total quantity. We importantly give necessary importance to the weights or quantities. So that's how we are. That is the weighted average method. So there are few classes which I've done on the YouTube of Unacademy channel. In the same channel, you'll find some sessions on how to do this FIFO, LIFO, SAMBAC. If not, you can get in touch with me. Drop a message. I'll share it. So that's something very easy, which you guys must revise on how to prepare, how to find out the value of inventory under FIFO, LIFO, SAM method, SAM and WAM method. That's important. And COGS formula, what I've already discussed, it's very crucial. Based on this formula also, the questions can come. You should be able to do this. And then let's understand the next part. Adjusted selling price method also, there are a couple of questions. It's very easy. You just need to do cross multiplication. What they would have done is they would have given you the closing stock value at selling price. They would want you to find the closing stock value at cost price. They would give you the purchases at selling price, purchases at cost price. So then write purchases, cost price, selling price, closing stock, cost price question mark, selling price given. Do cross multiplication, we'll find the cost price of the closing stock. If they don't give closing stock at selling price, you can apply opening stock plus purchase minus sales, everything at selling price to arrive at closing stock at selling price. That's one simple thing that you need to remember. Remember, Rewatch this last 1 minute, whatever I told slowly. You will get the catch and then solve the problem on adjusted selling price. Please do revise that, very important aspect. Then the most important aspect is stock reconciliation, the last part of this chapter. Stock reconciliation, what happens is the concept is very, very practical. Lot of times, because of practical difficulties, it will be impossible to value the inventory on the closing date. Valuation of inventory will be done either on a date after the closing date or it will be done before the closing date. They will give you such other than closing dates value and ask you to find the value of inventory on the closing. So first you need to figure out whether the date given is before or after. If the value of the date, valuation date is before the closing date, then it is forward problem. They've given the inventory was on 25th of March. We're trying to find the inventory on 31st of March. We're moving forward in time. When we're moving forward in time, all the transactions that has happened within 25th and 31st of March needs to be adjusted for, which will be given in the question. All the inflows will be added and all the outflows will be deducted. See, add inflows, deduct outflows. In the physical inventory before year end is given, book inventory needs to be found as on the year end. We call it forward. In certain questions, they give inventory after the year end. They'll give 5th of April stock and ask you to find the inventory as on 31st of March. In this case, you are coming back in time. When you're coming back in time, what you need to do? You need to deduct the inflows and add the outflows, and that's how we arrive at the inventory as on the balance sheet date. Certain cases may they will give valuation on 31st of March, ask you to find on 31st of March, but there will be some errors which we need to rectify. Yeah, these errors can be, these items can be arising because of goods sent on return or approval basis, or consignment stock, or loss of goods, or eliminating profit element. These items you need to be careful. What you need to be careful about goods sent on return or approval is goods are only sent, goods are not sold. So, though you don't have possession of these goods, you have the ownership of these goods. Yeah, this is a separate unit. We'll discuss it in the next video. What you need to remember is the goods are sent but not sold. Though the possession is with the customer, ownership is with you. So when you count the inventory physically, it might not be there in your go down. So it might not be there in the first item that you start with. But still, you would have to include this into your stock because you are the owner of this. So goods sent on return or approval lying with the customer, which are not accepted by the customer, time is still there for the customer to return. Would have to include it in your inventory. This has to be adjusted, added. Got it? Then consignment stock again. Consignment may some adjustments is goods sent on consignment, some adjustment may goods received on consignment. You need to remember whether you are consigner or consignee. Yeah, consignment again we'll discuss in the next topic. All you need to remember is consignment stock needs to be included by consigner. Needs to be included by whom? If you are a consigner and you send goods on consignment, ownership is with you, possession is with consignee. On the year end, in your go down when you count the inventory, consignment stock will not be there. But still you would have to add it to your closing stock in the go down to arrive at the closing stock as per. However, if you are consignee, you have received goods on consignment from consignment. If you have not sold those goods on consignment, they will be lying in your go down. When you count the inventory, those goods might be counted, but that should not be taken into your book inventory. It should be eliminated because you are only having the possession of those goods, but you don't have the ownership, and you cannot include that stock in your book inventory. Remember this. This is one of the beautiful adjustment, and there will be some loss of goods, goods lost by damage, pilferage, and all that needs to be adjusted. And the next thing is whenever you do all this adjustment for sales, sales return, and everything, remember that there will be at selling price, we need to identify the cost price of the same by eliminating the profit element and then record. How do we do this? They will usually tell us the relationship between the cost and selling price. If they don't, we should identify the same. Whenever they give it percentage on sale, no, they say 20% on sale, eliminated 20% on selling price to arrive at cost price. However, if they give fractions and on the cost price, remember this relationship will come into use. Whenever they have X, no, you are over your X, that is on cost. When your X is sold, you are over your X, but your X is with someone. So meaning on cost, if it is 1 by X, on sale it is 1 by X plus 1. On cost it is 1 by 1. Once sold, you are the one. You are over your x is also 1, but your x is with someone, is 1 plus 1, so 1 by 2. All that I'm trying to tell you is, if the profit is 100% on cost, that profit will be 50% on selling price. Similarly, if it is 1 by 3 on sale, then on cost it will be 1 by 3. 3 is your x is there with someone, eliminate that sum 1, you will get 1 by 2. You get this? So 1 by 2 is 50%. If the profit is 50% on cost, it is 33.33 percentage on selling price. You get this? Or if it is 1 by 3 here, then here it will be 1 by 3 plus 1, which makes it to 1 by 4. That is nothing but 25%. Did you understand this? So all you need to remember is, you are over your x at cost, but once sold, you are over your x and your x is with someone. So if it is 1 by x on cost, it is 1 by x plus 1 on sale. So when they give fractions, remember this logic to identify the on cost percentage or fraction, which will help you eliminate the profit element from sales and sales return to arrive at the cost price, which needs to be adjusted in the stock reconciliation table, because the closing stock is to be found at cost price. I hope you understood this part. And lot of problems on inventory taking are to be solved. We've done a lot of them in special class and here on Unacademy platform also. Yeah, I can share you the detailed Excel sheet on the topic of valuation of inventory for the MTP that I've done very recently. A week ago is when I solved that. So you can go through that and then get some booster. This is the important part of valuation of inventory, stock reconciliation. Don't miss this. And a lot of them do find it difficult. At least go ahead and then do last few RTP, MTP, and exam questions, and a similar question would come up in your exams. And that, my friends, is the revision of the topic of rectification of errors, BRS, and valuation of inventory. I hope you understood chapter say 2, unit 8, chapter 3, and chapter 4. That's the end of part 2 or lecture 2 of our CA Foundation Marathon Revision. Hoping to see you all in part 3, wherein we'll do the topics of depreciation and special transactions. Till then, remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So, thumb rule to stay happy is pretty simple, guys. It is to stay in the game. So, for one last time on this day, I have just one simple question to all of you: are we in the game? I hope the answer is yes, we are in the game. See you all in part 3. Till then, tata, bye, take care, and get lost.